Today we're going to talk about a recent email that I received from a client living outside the US. He sent an email that says, "I've been reading your newsletter and feel confident that I qualify for the Foreign Earned Income Exclusion. I've been claiming it for years on my self-employment income from my LLC in the US. However, this year I took on a partner in the US who is doing a lot of work. Can I still get the Foreign Earned Income Exclusion on my share of the partnership income?" That's an excellent question. I'm going to back up a little bit and talk about how the Foreign Earned Income Exclusion works specifically for a self-employed business, because in some cases it's not as logical as you may think. And then we're going to look at what happens if it's a partnership, and especially if one of those partners lives and is working in the US, because then it can be kind of tricky as to how the Foreign Earned Income Exclusion applies. If this is your first time listening to this channel, my name is Alex McGowan. I'm the owner of McGowan Tax LLC, where we help individuals and small businesses with international operations or to international assets comply with the complicated US tax laws, as well as save taxes where we can on international activity and international operations. So again, today we're going to be looking at this question of Foreign Earned Income Exclusion and self-employed businesses and with partnerships in the US. All right, so first I want to take a step back and look at how the Foreign Earned Income Exclusion applies to self-employment businesses in general, because there's one particular aspect that I feel like catches a lot of people off guard, tax practitioners and expats themselves. So I'm going to walk through a simple example just to show you how that deduction works. So let's assume you're a self-employed person. Say you have an LLC in the US and you have gross income of $150,000. So that means income before you have any deduction. And then you have expenses of $120,000. So that's your deduction. So your net income is this $30,000. That's your net income. So most people think the Foreign Earned Income Exclusion, assuming you meet all the qualifications, you're eligible for about $125,000 of an exclusion against your earned income. So most people would think, okay, I have a $125,000 exclusion, net income of $30,000, I'm not going to have to pay any income tax. The problem is that's not necessarily true, and I'll show you why. The Foreign Earned Income Exclusion is applied against your gross income, and then you have to take a percentage of the deductions and apply that to the amount of your exclusion that exceeds the $125,000. I know this is a little complicated and math can be tricky, but that's why I wrote it out here, and to hopefully make it make sense so that at least you're not surprised when you have this situation, you still owe a little bit of tax. In general, so in our case, we have $150,000 of gross income, so we can apply $125,000 of Foreign Earned Income Exclusion against it. So we're left with $25,000 of gross income that has not been excluded. So in that case, now we have to apply our expenses against this $25,000. But we can't take all the $120,000 of expenses to reduce the $25,000, because clearly some of this was related to the $125,000 that was already excluded. So you have to do a proportion. So what we do is we take, if you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. The $25,000 of gross income that's left over divided by the total gross income that you had in the first place. So we know that that percentage is the amount of income that has not yet been excluded to the total amount of income. We multiply that by the total deduction. We take this percentage, the percentage of income that has not been excluded to total income, applies to the total deductions, so that only $20,000 of the deductions apply to the income that hasn't yet been excluded. The amount of income that ultimately is still taxable is this $5,000, or 5 in my example, because you can't take the entire deduction amount. So even if you don't understand how this math works exactly, and you may have to watch this a couple times for it to sink in, but either way, the point is, if you have gross income of more than the exclusion amount, and after your total deductions there is net income, you may, after the math shakes out, still have income that's taxable after the Foreign Earned Income Exclusion, even though your net is less than the total. So keep those things in mind as you're applying the Foreign Earned Income Exclusion to your self-employment income. So that's how the math works in general. But let me talk about how that impacts you maybe in the real world. So a lot of times what happens is I have people call me that move abroad and they're already familiar with the Foreign Earned Income Exclusion. It's something you can Google and talk to multiple people about. So I mean, there's a lot of information out there on this concept. But maybe they talk to another practitioner that told them earlier in the year, hey, you're only making $30,000 of net income, you're eligible for the foreign earned income exclusion. Don't worry about paying estimated taxes. You're not going to owe any tax. Well, what happens is you end up owing tax, and this can be a lot worse as the income number goes up. If you end up owing tax, there's no withholding tax, and you're required to pay estimated taxes throughout the year so that you're not penalized come tax time. In these scenarios, first of all, it's just uncomfortable to get surprised with a tax bill come April 15th. And secondly, you don't want to pay unnecessary penalties. That's the number one thing I'm trying to avoid for my clients. Getting this math right on the front end before it comes tax return time is very important, or just understanding that it's something you need to look into and you may not get that full exclusion. But now let's talk a little bit about how this could apply to the partnership scenario. So once you figure out that you're eligible for the exclusion and how that math can shake out, another thing you have to take into account is how that business earns money. So if it's purely a service-based business, which a lot of my clients are, you don't really have to worry about this piece. But if you do have a capital-intensive business, so let's say you're selling an actual product, you have inventory, in that case, you do have limitations on what's eligible for the foreign earned income exclusion. And it kind of makes sense, right? Because the exclusion is meant to apply to service-based income. If some of your income is from the sale of products, then that's not technically what the exclusion was meant for. So what the IRS does is that if you're considered to have a substantial amount of your business related to a capital intensive business, there's a 30% limitation on the net income of the business that can be considered eligible. And again, we get into math with that and it gets a little bit complicated, but I think the takeaway that you need to know is if you are selling products and the income is at least in some part dealing with capital or assets, we need to figure out if it's substantial first, and if it is, we need to apply a limitation potentially, or figure out a way that we can get around that so that you can get the full foreign earned income exclusion. So once we get past that step, and let's say that the capital part is not an issue and you're going to get the full exclusion, what do you do if this self-employed business turns into a partnership and that other partner is performing services in the US? Well, in that case, there's really two options. The first one is you can make the equivalent of a salary payment to you, the person outside the US, and that's called a guaranteed payment when it comes to a partnership, because technically a partner can't be an employee in their own partnership. But the IRS has ruled that that guaranteed payment is related to the services provided by the person that receives it, and so it's inherently foreign sourced and earned. Inherently foreign sourced because I'm assuming in this case that you're performing those services outside the US. So it really works the exact same way as a salary or any other self-employed income would once we get through those other steps we talked about earlier. The other option, if a guaranteed payment is not practical from a business perspective for some reason, and just to define that really quickly, what a guaranteed payment is it is kind of what it sounds like, in that you set up a payment to the partner that is paid to them annually or monthly, just like a salary, in that it's not tied to the profitability of the company. So you can't not pay it because the company wasn't profitable. It has to be a guaranteed payment, as it said. So if that's not practical from a business perspective, the other way is we have to figure out how much of the net income is actually considered foreign source. And that can be really tricky, because what that is the sourcing is based on the value of the services provided physically outside the US. So if you have two partners providing services, one in and one out, you have to value how much the services related to the partner outside the US is. And then we have to put that on the partnership return and have it flow through. Now, again, that's a second step and more complicated. If you can do the guaranteed payment option, it's much simpler. But once you value those services and the amount outside the US, then you can show that on the US partnership income tax return. And at that point, what I recommend people do is put in the partnership agreement that the income that's attributable to foreign source services is directly allocable to the foreign partner. The US person's not getting any benefit from the foreign source income in that case, whereas the foreign partner is able to get that foreign earned income exclusion on the foreign source piece. And then you have to go through the deduction concept that we just went through before of allocating the deduction to that gross income that's sourced. But that's a more complicated option, and one you can do if the guaranteed payment doesn't work. So just to recap all this, if you have a self-employed business, make sure you're not caught off guard by the fact the foreign earned income exclusion is an exclusion on your gross income. So if you have more than that $125,000, just keep in mind that there may still be some income that doesn't apply to the foreign earned income exclusion. And then if you have a partnership, my recommendation is to make things simple and set up a guaranteed payment that's just clearly eligible for the foreign earned income exclusion for that partner. Otherwise, Otherwise, you can go the more complicated route of valuing and sourcing the income of the partnership itself. If you're thinking about setting up a partnership, or you have a self-employed business outside the US and you have questions about how you can apply the Foreign Earned Income Exclusion correctly so you don't get penalized and you get as much out of it as you possibly can, contact us today for a free consultation and a free cross-border tax diagnosis. If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.